Morning, Eric. Morning, Abby.
Good morning.
Welcome. It is 8:30, and it is time to get this party started. I'm Brian Hayduk. I will be your host. Sorry to disappoint those that were expecting Steve Cass or Taylor Duncan, who normally do this, but the stars of our show are fantastic. So joining me, we have Abby Grasshoff, our incredible senior markets analyst, and we have Eric Bratcher, who many of you probably know already, our chief risk officer and overall market guru. If you don't get the Zoltar reference in their titles there, your homework is to go watch the Tom Hanks movie Big, and all will be revealed at that point. Just a reminder for folks, the audience audio is off, so if you want to ask questions, you got to go to the Q&A in the function up top. We will have time. There's also an email address that we'll put up at the end, so if we don't get to your question and you want to submit it, please do, or if you just want to contact us. Just to tee this up a little bit, the focus of this is the ERCOT market here in Texas, specifically this somewhat strange dynamic where spot prices, index prices have been pretty low with limited volatility. At the same time, we've seen some increases in the forward market, but no real major jumps. And this kind of, call it this relative calm, has been in the face of the news that's out there that we should have a data center on every street corner. Crypto growth is going to continue. We've got population growth in Texas. We've got nearshoring or onshoring, I should say, of manufacturing. So what we want to do here is sort of explore what's going on. How long will this sort of these somewhat good times last? And to dig into that, we're going to do what you do with most commodity markets and most markets in general, which is we're going to look at the supply side of the equation, we're going to look at the demand side of the equation, and we're going to look at what's the impact on you, the impact on prices. We don't have a ton of time to get through all of that, so I'm going to pass this over to Abby to get us started on the supply side.
Thanks, Brian. All right, so the first section is the status quo of the ERCOT grid. And to kick things off, let's take a look at the current makeup of the grid. This is the generation by fuel type for the last full calendar year, 2024. You've got natural gas broken out by combined cycle and peaker plant. That means combined cycle is it's a plant that runs a little bit more efficiently, and a peaker plant is designed to ramp up or ramp down at a quicker pace. So we've got those two split out. We've got coal, wind, solar, nuclear, and that little purplish sliver up there at the top is batteries. So about a third of the generation stack is renewables that are intermittent resources and dependent on weather. And the other 60% or so is made up of gas, nuclear, and coal. So let's look at the growth of natural gas generation. This we've got cumulative megawatts of generation capacity of both combined cycle, which is the darker blue bar, and peaker plants, which is the lighter blue bar. And this goes all the way back to 1999. The addition of maroon and green in the years 25 through 2030 represent what's in the interconnection queue, which is a list of proposed new generation projects that have been submitted to connect, and these projects are slated to come online and bring just additional generation megawatts to the grid. So IA just means interconnection agreement, and the maroon means that they've posted financials, which just means that they're a little bit more probable to come online than the green projects. But we can see that gas-fired generation growth has been pretty limited over the last 10 years. Capacity for combined cycle has increased a little bit, while peaker capacity has decreased, essentially making that growth flat. We had 65 to 66 gigawatts of capacity 10 years ago, and we have roughly about 69 gigawatts now. and the only growth in the queue is another 5 gigawatts or so.
Speaking of queue.
Yeah, speaking of queue, what's not included in the previous graph is the Texas Energy Fund. So this is something that we all voted on, and it was designed to provide low interest loans to build dispatchable generation. And these are the 16 projects that were received in the application process. So out of these 16 projects, only the 2 circled in blue have moved forward. The projects highlighted in yellow have dropped out for various reasons, mostly centered around the strict completion time deadlines that is a part of the loan application process. So as it stands, that 580 megawatts or so is what's slated to move forward. And is that going to be helpful? Sure. Is it likely to be the thing that bails us out of any future supply constraints? Probably not.
Yeah, not that size, not yet.
Yeah. Okay, so what else is in the queue? We're looking at generation capacity by wind here. And unlike natural gas, we have seen some pretty decent growth over the last 10 years with capacity more than doubling since 2015. So currently we're sitting at about 40 gigawatts, and the projects are slated to bring us up to about 48 gigawatts in the next 2 years. But then you'll notice that there's nothing in the queue after 2028. So that growth is expected to kind of stall in the next couple of years. We also have solar, which has been growing significantly. We started with 121 gigawatts in 2013, and now there's generation capacity north of 30 gigawatts in 2025. So that's pretty significant growth, right? And that is expected to essentially double by 2027. So that steep slope of all this growth is expected to continue through 2027, after which, again, it sort of stalls from 2028 through 2030.
And lastly.
And last but not least, we have battery. And battery growth has basically been exponential for the last 6 years or so. We have 10 gigawatts of capacity in 2024, and that jumps to nearly 30 in 2026. And we're supposed to have nearly 45 gigawatts of battery capacity by 2029. Batteries are really popular right now because they're really good at displacing natural gas and ancillary services because they don't require fuel, which is a lot of what Bratcher is going to touch on next.
Yeah, so all of that generation, when you look at how it actually performs in a specific day, looks more like this. This is just a random day we picked from earlier this month. The top of this line, or these are like stacked areas. The top is the load as you go through the day of this early day in September, and total load in that day was about 70 to 75,000 megawatts, which is pretty common for a not the hottest day of the summer, but a decently warm day in the early fall, late summer. And you can kind of see that massive amount of solar that has been built has put a lot of displacement or displaced a lot of natural gas. So it doesn't require as much natural gas to be turning and spinning in the middle of the day. And all of that increased solar that Abby was just talking about in the queue is just going to continue to increase that orange area, putting downward pressure for almost all the time in the middle of the day on those natural gas and even some coal. You can see the coal line is even depressed in the middle of the day. So solar is displacing both gas and coal in the middle of the day. And then batteries are what comes in and helps solve that sunsetting reality of the solar falls off completely about the time that the sun sets. Those batteries fill in that gap to replace that natural gas generation. When we look at all of these nuclear, coal, and natural gas fired generation, we have a total of about 72,000 on a summer day, maybe 73 or 74,000 megawatts on a winter day, just based on the ability of them to produce. So at any time when load is greater than 72 to 73,000 megawatts, we need some of these other generation assets to step in. Wind, which blows fairly consistently, but not always. It almost it kind of reduces during the middle of the day a lot of times in West Texas. It has a tendency to just be variable. It's one of the most variable generation assets we have. Solar, more dependable in the middle of the day, but very high probability that it goes to zero at night, right? So that variability of that generation is what helps that battery fill in those gaps when it's not there. This is a typical summer day. A winter day is almost the exact opposite, where this peak happens in the morning, also when solar isn't quite there and available. So that battery, whether it's the winter filling in from 6 a.m. to 8 a.m. or in the summer, those batteries filling in from 6 p.m. to 8 p.m., they're filling in that gap and then charging in the middle of the day when solar is strong and load is light. So that's the supply as we're sitting now, and for the relatively short-term to medium-term future of the next 3 to 4 years, right? With not much else going to be built other than what's already in the queue and being planned out. So the biggest question there, the supply side is kind of known, fairly well baked, is how fast is the demand side of the equation growing, right?
Right. So yeah, let's talk about demand. Every year, ERCOT posts their long-term hourly peak demand and energy forecast. That's a mouthful. They post it in the spring, and the next couple of slides are some charts that we pulled from that report to kind of set the scene on how demand is looking in the near future. So this is ERCOT's load forecast inclusive of TDSP large additions. So what that means is that if a large load wants to come and connect to the grid, the first place they start is with your TDSP provider. And it actually wasn't until pretty recently that ERCOT started using those connection logs from the TDSPs into their load forecast. So I think it was spring of 2024, if I'm not mistaken, that those started to be pulled into this forecast. And that's what this chart that we're looking at right now is. And it breaks the load forecast out by industry type. So you can see that ERCOT is saying that between this year, 2025, and 2031, demand is supposed to go from 94 gigawatts to 218 gigawatts. That's significant load growth, right? And data centers are primarily what's driving that load growth. That's the gray bar that's increasing pretty significantly every year. We have some growth in crypto, some in industrial and hydrogen, but most of all of that growth is being driven by data centers. ERCOT is skeptical of all of this load growth. They think that just because somebody is signing up and saying that they're going to come build a data center in Texas, it doesn't mean that actually is going to come to fruition, right? So they actually apply a discount to their load growth forecast, and that's what this chart is forecasting, or at least the red line is forecasting that load growth with a discount. The blue line is actually historical peak demand going all the way back to 2002. So with ERCOT's discount, they're saying it's not going to go all the way up to 218 gigawatts. We're only going to peak at 144 gigawatts by 2031. That's still very significant load growth, because over the last 10 years, we've only had an annual average growth rate of about 3%. And even with ERCOT's pessimistic view or discount, that load growth increases from 3% to 10% for the next couple of years, up to 16% in 2028. And then it kind of the slope of that curve decreases a little bit on those outer years, but that's again still very significant load growth in the pipeline.
And it's not a minuscule discount. I think for the data centers, they're discounting those interconnect, that large load that they're getting from the TDSP, those numbers, they're discounting by about 75%. So heavy haircut on the data centers. The other classes are discounted between 30 and 40%, depending on which class you're looking at. So it's not minuscule. It's actually very massive. And even what's left is still very hockey stick looking and quadrupling at least the growth rate that we've seen over the last 10 years. this was the forecast. They were forecasting about 85 this year, and that came in about 83. We'll talk about that in a little bit later, since this is pre-summer and now we're looking at post-summer. So we're starting a little bit behind where we thought we were going to go, but that's also part of the story that we'll get into in a minute. So you take all of these things together, the generation that we currently have by all of its types and when it's likely to be able to generate, if it's a non-dispatchable generation, like when is the sun shining or when is the wind blowing. You take all that and then you extrapolate what else is coming and you build up massive models. ERCOT does this all the time, and specifically in their long-term planning. And then they look at all of this additional load and say, what does that supply demand equation look like from a reserve margin point of view? And that's where the rubber meets the road as far as any ISO, whether it's ERCOT or PJM, is looking at those forecasts of growth of supply and growth of demand to determine how much excess reserve do we have. That's what they call that reserve margin. Most ISOs, ERCOT, PJM, New York, like that to be a healthy 12 to 13%. It's kind of ERCOT's goal. ERCOT doesn't have any mechanism in the market to make that happen, but from a economic theory point of view, it is desired, or at least it's believed, that a 12 to 13% reserve margin is the best of all worlds as far as having enough reserve that it's still healthy for generators and not too little so that prices are exponential and volatile for consumers. So when ERCOT puts all these numbers together, they publish a projected reserve margin for both the summer on the left and the winter on the right. So they do all that math, and because there is a difference between peak load at 4 p.m. and peak net load, which is basically how much generation is available minus the renewables, because that the solar cuts out over all, as soon as the sun sets. So what's that peak net load hour? They have two lines, right? The reserve margins for 2026 look very healthy. A lot of that is because that load, that kind of hockey stick of load growth, doesn't really start to manifest itself until later on in the forecast of 27 and 28. That's where we were seeing that 10% year over year and the 16%. So in 2026, those reserve margins look really good, especially in the winter at 29%. That's very healthy. All that solar and all that battery and is outpacing load, at least in the last few years, right? Those numbers become negative relatively quickly, and almost regardless of the model. ERCOT has, if you want more details, you can hit that QR code. ERCOT has multiple models and multiple iterations of how does that Texas Energy Fund, those projects that we were talking about at the beginning, what are some different scenarios of their efficiency and effectiveness, different load equations, high PV, low PV, electric vehicles. They kind of do a lot of different models. This is probably the most conservative, the ones that show the highest reserve margins given that discounted load forecast. So basically everything looks really good in 26, starts to get below that specified, that goal of 12 to 13% by 2027. And then on the hottest days of the summer or the coldest days in the winter, you have a much higher probability of not having enough supply to meet demand. So that's the world as far as the forecast go. Now let's take a switch and look at the market. So everything else up to this point has been really ERCOT driven. ERCOT doing a bunch of analytics on generation, a lot of analytics on load, but ERCOT doesn't make prices. The market makes prices. It's the market every day trading that determines the price in the wholesale market, that takes all of that risk that they're seeing from ERCOT publications and determines what price should I sell or what price should I buy electricity for tomorrow or next month or next year or the next 5 years, right? We'll start with what prices were looking like going into the last few summers, and then compare what that has looked like over the last 2 summers in reality and spot prices. This is a chart of the prices for the last 4 summers and kind of the last price going at the very end of May, going into each of those last few summers. 2022 was right there after Russia invaded Ukraine. Natural gas was extremely expensive during the summer, especially the early summer of 2022. That year, gas was $7, $8, $9 across the summer, and prices going into the summer were about $145. So lots of risk, most of that driven by natural gas in 2022. 2023 was a very different year, very low natural gas prices. We hadn't had the summer of 2023 yet in May of 2023, and wholesale prices were about $51. So over the last 4 years, those have been the high and low water marks of wholesale electricity prices going into the summer. After the summer of 2023, or during the summer of 2023, we saw very high spot prices, and the forward summers reacted accordingly. So the next summer, it was much higher. It was trading as high as 110. By the end of May, it was about 92. And then by this summer going into it, after having a fairly mild summer of 24, it was slightly discounted. So it only got up to just south of 100. And then by the time the end of May was here, it was closer to 74. So that's what the market was seeing as risk for the wholesale prices for each of the last 4 summers going right into it. High of 145, low of 50. And then the last 2 summers, somewhere between $75 and $100 per megawatt hour for the strips that were June, July, and August. This is the reality of those prices. So the averages of those last few summers are the top right-hand corner. The summer of 22 cleared at about $100. So that summer was originally 145. It cleared at 100. The summer of 2023 is where we had a lot of that volatility. It was the one that was going into the summer was trading at 50. It cleared at 100. And then the last 2 summers, 24 and 25, cleared significantly lower. 2024 was the one that was $94 to $95. It cleared it under 30. And then this summer, where going into the summer, it was closer to 75. It cleared at 32. So very mild for the last few years, or lack of volatility. A lot of that has been driven by the massive increase in solar, a massive increase in batteries over the last few years. The summer of 2023 was where it was very hot. That was that black line where the average highs in August for North Texas were 104. So every day of the month of August had the average high of 104. So many days were higher than 104. This past summer, it was 94. So a 10-degree drop. So that drop in temperatures, not only in North Texas, but all across the Texas, really helped over the last couple of years, but it wasn't the only piece. Demand was a little bit lower. Like the peak demand this summer was about 83, like we were talking about just previously. Last summer was about 84, and the summer before it was about 84, 85 too. So load has been relatively flat, even with a much cooler temperatures. The peak load demand in the last few summers have been relatively the same. The biggest change is the massive growth in solar and battery that's really made that equation swing towards a oversupplied market, very similar to what we were just seeing in that projected reserve margins of ERCOT being, significantly above the 15 or even 20%. So as far as how the market is performing, it's a kind of a buyer's market and spot market. The market is oversupplied, load has been slow to grow, and we've been very blessed with, if you're the load side, you've been very blessed with very mild temperatures over the last two summers compared to the heat that we saw in 2022 or 2023. So that's the spots. Now let's look at the forwards that have been reacting to those spots. So let's set this chart up a little bit. First, we have the last few years, the years that are now in the past for the most part as far as trading. 2023, that blue line, 2024, the black line, and 2025, the green line, is each calendar year for 1 megawatt across the entire year. So it's a kind of a flat average. And you can see a decent amount of volatility back in 2022 when natural gas prices were quite high. You then see the summer of 2023 right here kind of blow up. That was when it was very hot and wholesale prices were very escalated. You saw those prices jump up and then kind of calm back down in over 2023 and 2024 until this happened. That big knee-jerk reaction or pop in the market there was when ERCOT released their first massive load growth forecast based on those TDSB queues, all that data center load. That was that knee-jerk reaction going into last summer of, oh man, there's a lot of load in the forecast coming. And then it took a very mild summer and kind of a realization that all of this isn't going to be built nearly as fast as everybody was fearful of, and the markets fell back down to their lows last September. Since then, all of these next years, 26 through 2030, have been kind of at a steady climb. You saw a little bit of escalation in April, a little bit of a sell-off right there in late March and April when we were talking about tariff and recession fears, and then beyond that, a nice steady drop all the way until about August, and then a reversal and kind of keeping up that constant upward trend. So the market is seeing all of these things, seeing the very low index prices, but not reacting nearly as much as it was a couple of years ago, even though there's been a continuation of how much data centers are coming, how much, as you continue to progress through time, a lot of those are becoming reality. A lot of those are falling off. There's a clearer picture of what's going to be coming in 26 and 27 now than there was, a summer or a year and a half ago. So that's, I guess, long story short, the market sees the volatility in the short term or lack thereof, and is pricing some of that risk in the forwards, but not nearly as much as that reserve margin going to zero or even negative by 2028 would imply, right? So there's a definite wrestling in the market of we're oversupplied in the short term, likely, which is why spot prices have been so mild over the last few summers, helped by cooler weather. But we're not discounting the forwards completely just because of the short-term realities of an oversupplied market, because there is still a significant risk that massive low growth could come in the next few years. So the market is wrestling with those, how much of that load is actually going to come into fruition, and what might that do to markets over the next few years. It's going to be a slow-moving story. It's not like we're going to wake up tomorrow or the next week or the next month and there's going to be a big green or red light that flashes and causes these markets to move. It's going to be a progression of the reality of how fast these large loads and some of the rules that we've implemented since then impact them. Senate Bill 6 was one of the legislative rules that we passed this last summer that should make sure that some of these large loads that are in this intersection, these big, massive data centers, pay for their fair share of the costs that they're incurring, not so much the market-driven costs, but some of their direct costs. So the market is absolutely wrestling with what does that all do to the equation, to the supply and demand equation, and just how fast will that load go. So when you boil it all down, yes, the market is elevated more now than it was a year ago, but not massively. It went from about $50 of its low, all of these years have a low price of about $50 a megawatt hour, going back all the way to early 2023, and over the past 12 months it's elevated to about $60 a megawatt hour. So you've seen that's 10 over 5, so a 20% increase in cost or in forward markets, but not nearly what would be implied if ERCOT was assuming that we're going into the negative territory in just 2 or 3 years, right? It's slightly elevated, so the market sees some of that risk.
Forward years 26 through 2030 are all right on top of each other, and ERCOT's reserve margin is showing to go negative by 2028. So, by looking at this forward curve, that negative is not necessarily being priced into these forwards right now, right?
Yeah. So you could say that another way is the market is even discounting that load growth by ERCOT significantly by having a market that basically says 2026 and 2028 and 2030 are all relatively the same price. So boiling that all down into kind of a summary and recommendations kind of looks something like this. Summary, how do you put all these last 30 minutes of talking into one or 2 or 3 points? The largest variable in all of this isn't necessarily the supply or when the supply will spin or how fast the wind will blow at certain times. That is a variable. We're not forgetting about it, but the much larger variable that is driving the vast majority of the volatility in the forwards is how much will the load growth, how much will it materialize, how much will all of that increased load materialize, and when, right? If it shows up in 2030 instead of 2028, that will have a large impact for 27, 28, and 29. So that's kind of the rule number one. The second one, and I'm going to read all these to you because you can read faster than I can talk them out. The value of curtailability, or the value of being able to curtail, is very high now, meaning that that difference between the forwards and the spot price is that opportunity for curtailment to maximize that arbitrage capability, or the cost avoidance of not buying in the forwards. The problem with that is you really need to be curtailable, because if things go bad, you need to be able to turn off, because as this market continues to evolve of higher load and less deployable generation, the frequency of those price excursions in the real time is going to increase. So your ability to curtail and avoid them is definitely increasing in value. Today is this summer was a perfectly good example. But as load continues to grow, it's not going to make every day more expensive. It's going to make a few hours more expensive more frequently. So that value of curtailment will just continue to increase. And then the recommendations, because there isn't a one size fits all recommendations, I kind of threw some classifications or kind of groupings, and you can decide which of these groupings you fit into. If you or your business or entity is risk averse, then you really should consider looking into and locking in some of those forward prices for the years of 2027 beyond, while there's still some discount. Like Abby was just pointing out, it's flat. So the risk in all those outer years is relatively flat and only slightly elevated compared to what we've seen over the last couple of years. So if you're risk averse and you're like, I can't handle that 60 going to 80 and a retail price going from 7 to 9 or 10 cents, then it probably is advantageous to you to look at some of these forward markets and buy into it to mitigate your risk. If you're only slightly risk tolerant or slightly risk averse, but are willing to put some money on the table to gamble with, then look at locking in some of the portions. For the vast majority of larger consumers, you don't have to make your buying decision binary. You don't have to say, today I'm going to buy 100% of the next 3 or 4 or 5 years. You can do that in tranches and step into positions and reduce your exposure if the market moves up, but also allow some of that open position to benefit if load is slow or just load never shows up, right? If you're risk tolerant or are more curtailable, then understanding your facility's ability to curtail, understanding how much you can curtail and when, makes you able to be very strategic at the hedges you put in place, if any at all, and it allows you to avoid those higher frequency of price escalations. So if you're saying, yeah, I see all this, but there's no way we can afford to lock in at $60 or $70 forward power, then the alternative is to be curtailable, because it's almost certain that we're going to have multiple hours of very high prices. And yeah, I think that's just good enough there, right? So that's
Perfect.
That's a good summary and recommendations.
Great. Well, thank you, Eric. Thank you, Abby. We do have some questions, and we have a little bit of time for questions. So the first one is, I guess, data related. These inputs in terms of the supply side of the equation and the demand side of the equation that ERCOT puts out seems as more important than ever. How often does the market get updated on that data? What does the queue look like on the supply side and the load forecast?
Yeah, that's a good question. I'll take it, Abby.
Go for it, yeah.
So the load forecast, that big one that they publish with all those details, is annually, and it typically comes out in late winter, early spring. On the generation side, ERCOT publishes their interconnection queue, all those charts that we were seeing with the load growth and how much is coming for each of the category. They publish that monthly with all of the details of who's new to the interaction agreement or interconnection agreement, who has fallen out of the previous time they do it. So the supply side is a lot easier to keep track of, because it's who's in the queue and who's progressing. So ERCOT publishes that on a monthly basis, both for like the next few months and then the next few years. So all that is available on ERCOT.com. The load forecast, where they have to take, hundreds or thousands, tens of thousands of data points to come up with a load forecast, where they're looking at macro and micro impacts. That's annually.
Got it. A couple maybe more on the supply side. So one of the questions, why aren't more developers taking advantage of the Texas Energy Fund?
Yeah, I mean, I don't think it's a single answer. I think
also just remind people what that is.
Yeah, the Texas Energy Fund, it was a legislative movement from 2 sessions ago. We, as the state, voted on it. It was called Prop 7. That's 2 Novembers ago that we voted on it and passed it. It's a fund paid for by our taxes, not paid for by your electricity rates, coming out of the Texas Fund, that provides grants and low interest rates to deployable generation assets, natural gas fired generation, if they are built and completed in certain timeframes. And the faster it gets completed, the higher the grants. So it has a stair-step capability or kind of concept to it. I would say that they're still not cheap, even with a decent-sized grant and a subsidized loan. It's still not cheap to build. These are multi-billion-dollar projects that you're building, and trying to figure out where is the return of these assets. And most of those, the things that probably look the best for the market is those peaker power plants, because they can come in and relieve just like a battery would. The problem that I think a lot of them, if you're economically focused and looking at that, is you're competing against the batteries every day. So if that battery interconnection queue is still very massive, those peakers are competing against them, and those peakers are burning fuel to provide that power and have very high capital intensive at the beginning. It's actually probably cheaper to build a battery than it is to build a peaker plant. It's also a lot more available to build a battery than it is a peaker plant. The availability for batteries is a lot easier. There's a lot of manufacturers for them. You can get them installed much quicker.
For a peaker
plant. The space is a lot smaller, and you don't need power plant or large gas pipelines being to them. So it's a logistics problem, and it's an economic problem that they're trying to address.
Even with the cheaper financing, the economics just aren't there for those guys.
It's going to be hard. If the economics are there, they would be a lot faster to apply and get money and go faster. The second problem is it's just really hard. Texas isn't the only one that's looking for gas turbines. There's only a very small number of makers of gas turbines in the world. It's like 3 big major developers or manufacturers, and all of them have a massive wait time. So even if you wanted to buy one and you went to them and asked for one, you probably wouldn't get it until 2028 or 2029.
Got it. The other supply side question. So it looks like we still have a fair amount of solar in the queue, a little bit of wind, but still a fair amount of solar. With the Trump administration sort of pushback on renewables, how do we think about those renewables in the queue for ERCOT? Are we worried that some of those might not show up?
If anything, it will probably accelerate the development and completion of those. So there's 2 tax credits or 2 funding, a production tax credit and an income tax credit. Both of those have a much shorter sunset now than they did before. The projects have to be under construction by next year and completed by the year after that. So to receive the funding, I don't know. The market still doesn't know if that reduction in funding dramatically cuts the solar and wind. It doesn't have an impact on battery. Batteries were not part of that same grouping. So the batteries don't really change their economics in the short term because of the big, beautiful bill. It's mostly just solar and wind. Wind has been displaced by solar for the last few years anyway. So minimal impact to wind in Texas, at least. The biggest question mark on the federal subsidies is, will all the solar be front loaded and be installed and activated before the end of 2027 to take advantage of the production tax credit or the income tax credit, and then we have the kind of plateau thereafter? Or does just the economics still look good enough that they can handle the market prices, which are elevating? Probably some of that upward pressure is the fact that cost of new capital spent on solar will also be increasing. So, it's always an equation.
Got it. I want to go, you touched on this a little bit in the summary slide, and I think you were putting it in risk terms. I want to sort of go over it again, put it in product terms for customers. So if you were a fixed price buyer, say for 2027 going forward, would you be a buyer here, kind of looking at those forward curves that you were showing?
I mean, if you're probably, especially if you're a buyer whose budget is pretty sensitive to the escalation of electricity prices. I mean, you should at least be budgeting for that much spend, because it's highly probable that it's going to be there, right? Like this market hasn't shown a sign of going up to a point, down to a point, and staying in a range. It's constantly escalating. So I think to just hope for better days, if you're a risk averse fixed price buyer that needs that budget certainty, I think that might be a little foolish. I think it probably behoove you to at least budget for the current prices, and probably an escalation if you're not buying in the forwards now.
Right.
But it probably behooves you to be looking at it.
And similar sort of question, you had people who are willing to take a little bit more risk, so we'll put that in sort of a block and index type of product structure. What's your recommendation of those folks in that same time period?
Yeah, if you're capable of handling a little risk, or budgets moving around the realities of real-time prices, looking at hedges that probably, go ahead and bite the bullet and hedge a little bit higher in the more risky periods is probably the way to go. There seems to be lessening risk in the shoulder months, in the months that aren't the hot of the summer and the cold of the winter. Those months will likely be very oversupplied in the next few years. So there might be some benefit there of where do you more strategically place your hedges around the risk of when load shows up. It'd probably be taking a more strategic look at it, but layering in, especially the more risky times.
And as you said, that strategy, that approach is really meant for folks who can react with their load to spikes in prices. If you don't have the ability to curtail, it's probably not a fantastic idea to take much exposure. Would you agree to that?
Yeah, if you can't curtail, then when a bad summer or a bad winter event happens, then you can't avoid it. And the way this market looks, it may not take a lot of load growth to get to a point where prices become elevated much more frequently and stay that way. And if they do, if the market starts to see that really at all, then those forwards will pop very aggressively. Okay. So you'll be stuck either buying higher real-time prices or tapping out and buying very high forwards, which then you're just a price taker, and you're kind of forced into really hard decisions.
Speaking of prices popping, and this will be the last question. I know we only have 2 minutes left, but the question came in. Essentially, is it safe to say if we have a hot summer next summer that we will see sort of a material move in the curve?
In the curve, possibly. The heat, I mean, 2023, it's like the second hottest summer we've had in the last 30, 40 years. 2011 and 2023, and then 1980 were like the top three hot summers. So it takes a lot to be, an average of 104, 105 degrees for highs in North Texas for the month of August. If we were to see that, yeah, maybe, because the market has had a hard time figuring out just how high load can go. Same for the winter. This past winter, we hit about 80 gigs on February 20th, which had a low in North Texas of about 10 degrees. Nothing as cold as Winter Storm Uri, where we saw, -1, 0 degrees. So if we were to see a cold, like a 20 or 30 year low again, load would be exceptionally higher than it was in February.
Excellent. Got it. Eric, can you put up the last slide? We are just about at time. Thank you very much, Abby and Eric. Really informative. If we didn't get to your question, or if you want to contact us, you got the email address here. If you loved this so much and you want to watch it again, it will be posted on our webinar. If you missed portion of it, it will be there today. But thank you very much for everybody who attended, and again, you, Abby and Eric, appreciate it. Have a good day, everybody.
Welcome.
Thanks. Bye.